Okay, I mentioned earlier on that in our previous meeting, we agreed that we're going to solve these questions, but we be selective. We solve questions that would require calculations of some sort. And then if subsequent meeting, we'll now go back and solve all other questions that wouldn't require us to do calculation. So let's begin by, first of all, checking the number. You can take note, right? And please, your microphones. Or maybe some people are now joining.
3-3, Chelsea 3-0.
Okay, we had that one. Chelsea has scored 3 goals today. So far, I think they've not finished the match. We don't know. I don't actually know who Chelsea is playing with because I don't follow. But for records, today is the 12th of April, 2022. Okay, so please take note of the questions that will require us to do calculations, beginning from question 1, right? So that's it. It's scrolling up slowly. So just take note. It shouldn't take up to 3 minutes, I guess. Question 1. Please take note. Write them down. Write the questions down. Question 1. This will take like 3 minutes or so. And your microphones should please be muted. Okay, question 8. That's 2 so far.
Question 9.
Okay, yeah, question 9.
Question 11.
Yes, 11.
Oh.
We are almost halfway through the questions. There are 60 multiple choice questions.
I was typing them in the answer the chat, but the light went off.
Okay, you don't have power, right? Okay, question 25. Oh, I've scrolled too fast. Question 25. I'm going back. So we see from there. Okay.
Business angels. Things for you.
Please, why is question 40 highlighted?
Well, the answer is 4, but the answer is not in.
Someone asked why 40 is highlighted.
Yeah, and I was saying that the answer is not in. If you solve it, you get 4, but the answer is not in.
You get 4.
Yes, 4 years.
4 years. Oh, that's interesting. We'll find out. So
Yeah,
let's
sure.
proceed.
It's-
Okay. 40. We're now in 46. No, I think. Uh-uh. Okay. We're still here.
Is he off?
Hey, where's Fortune? I just joined though. Vanished.
When you drop, but he's now back.
You're welcome. You just joined. Okay, so 55. I went off briefly the network, but I'm back. So far, we've seen that question 1, 8, 9, 11, 25, 40,
But today you
51.
didn't visit your where you visited the last time.
No. I didn't go there. I'm home. So we've seen 1, 8, 9, 11, 25, 40, 51 so far. Part of the questions we'll solve today because they're calculations. So 55 is also part. So I think from 55, 56, 50, 56, 50, okay, 57 is not part of the calculations, but 58 to 60, as you can see highlighted there, will be calculations based on the data provided. Okay, so 58, 59, 60. So far there are 12 questions. At section B, out of the lots, we also have a number, I think a question there that will require that we do calculations, right? But if you asked, okay, question 2 has to do with finding, I think, payback period and net present value. But note that for this kind of question, you may be given the data and be required to find not just payback period or net present value, but you may be required to find the internal rate of return. You may be required to find a profitability index. You may be required to find the return on investment and what have you. But for this case, just 2. So we pray we're not loaded with so much in the exam. Okay, so all of these calculations. So let's move down to business. Go back to question 1. See, we'll begin at a very slow pace, and then if need be, would increase our pace. Today, my board is white, so I prefer to write in black, red, green. Beginning with black. This is our project finance. Trial questions, right? So question 1. Unorganizing, what is that? Is that sentence doesn't sound right. And organizing is considering 2 options. So it should be an organization is considering 2 options for a project with the expected cash flows for each options as follows, A, B. The question here is, assuming a capital cost of 10%, and here we've been given discount factors, they've made your work easier. You're given this 10% to find discount factors from a table, right? But they have rather listed the discount factors, so you don't need the table for this multiple choice question. As per NPV
Okay,
method.
sorry, but are you still sharing the screen?
Yes, I think you can see my screen.
Yes.
And okay, that's good. So we're going to find the net present value for A, find net present value for B, and compare answers and see which of them has a higher value. Once we get the one with the higher value, right? Then we take that as our best project. Okay, I'm just resetting my, what is this? Shape? No, not shape, not texture. Roundness. Okay, it's not round. Okay, sorry, the nib of my pen. I was just resetting. Okay, so we've been given here, I think 0, 1, 2, 3. Please, can you mute your microphones? Thank you. Cash flow. That's Chelsea, I can hear. Someone is watching Chelsea. Cash flows, okay. For the first project, I printed out my questions, so I may not be going back and forth, but let's see it for the last time. Take note, these are the cash flows. I'm going to list the cash flows for A and B, but I'll be doing that simultaneously as we discuss in line. You see, for the cash flow for project A, okay, we're starting with 500,000. That's your initial investment, 500,000. Project B is also an investment of 500,000. And for project A, by the end of the first year, you had this amount coming back to you. We had 250,000. You got back 250,000 but by the end of the first year, for the second project, you got only 50,000. You got only 50,000. Which of them is better so far? So far, so good. Project A is better because you invested 500,000. By a year time, you got back 250,000 coming back to you compared to 50,000. So far, without solving, we can see that A is far better. Then in the second year, we also got 250,000. It actually means that our payback period for project A is 2 years, because within 2 years, we got back the 500,000 we invested. But for project B, it was rather trickling. It was a very slow start, 500,000. For year 3, this rather dropped to 50,000. It wasn't as good as year 1 and 2. But for project B, this rather increased to 250,000. Okay, so B was picking up, or B has begun to pick up. Then the fourth year is 50,000, whilst B is 150,000. So which of these two do you prefer? Let's see, up to you, assuming we are stopping at year 4, you have 250, 250, 50, 50. So this is 500, 600. But for this one is 50, 50 is 100. 100 plus 250, 350. 350 plus 150, that is 500. So A still looks more promising. And then by year 5, there was a sudden turnaround. It was uniform, 50, 50, 50. But for project B, it wasn't uniform. It was rather escalating in profits. This is 500,000. So which of these two projects is better? So that's what we need to do now. So I think my space is just too wide. Pardon?
It will be B.
It will be B. Okay. Let's see. I'm picking something. I'm checking. I need my toolbar at the top here.
B.
I realized that my space.
Oh.
I'm sending this up so I can have space at the bottom. Okay, that's good. Okay. And even this one, I think I need to cut it. The gap is too wide. I might not have enough space to, so I'll still need to bring my toolbar and then trim this portion here. Okay. Let me make it a little smaller and then move it here so that I have enough space now to write. Okay, so let's proceed. Oh, there was no change. I didn't click OK, but let's go. What we need to do here, because we've been given a discount rate to use, and that is a discount rate of 10%, it means we have to bring our discount factor here. Discount factor for year one is always 1.0000. That is constant, right? Year two, it's given. So let's just write what is given. If you can take note and just mention, there's 0.909, 0.826, 0.909, 0.909. Year one is 0.909. Year two is 0.826. I'll not come back here. I have it already. So let me just write them. 0.826.
0.751.
0.751.
683.
0.683 and 0.
But there's no 0.683. It's 683. I don't know if it's a mistake.
It's a mistake, but it's a point.
Okay.
0.621. Okay, so that's it so far. Right. Then what do? We need to now to find our discount factor, DF, and discounted cash flow. We need to do that for project A and for project B, and then sum them up. How do you get for project A? We need to multiply A by the discount factor to get this. And then we need to multiply B by this to get this. Take note. So let's do that. So 500,000 times 1 is still 500,000. 250,000 times 0.909. Can someone quickly do that for us?
Mr. Fortune,
Yes, please.
can I ask a question?
Yes, you can ask.
This is a MCQ question, right?
Yes, MCQ. Yes.
And such a question, you are going to go through this process to answer it, or there's a fast way of answering.
No, you don't need to go through all this method. You don't need to go through. But even though it's a multiple choice, subsequently, I'm going to show you yes, I know. So I'm going to show how to do it without having to go through this one. but we're assuming that irrespective of the fact that it's multiple choice or we're going to make it an essay type, this is generally how we need to solve it
Because I
because it
remember
may
this
not
question we
be
have.
multiple choice.
I know we have solved such a question before, either the same or similar. That's what I'm asking that. So since it's a past question of MCQ question that we are solving,
Yes.
yes, I was thinking we should rather that's my suggestion. I was
Yes.
thinking we should rather learn what you are talking about now because we have solved either the same question or similar question.
Yes. Okay. Yes. That's what I
It's
want
the
to.
same thing. It's the same thing that
Yeah,
we
it's the
saw.
same.
Yeah.
Oh, okay. Okay. We've solved something similar, right? So let's just finish this one. And the other subsequent questions, we'll look at the ways of solving it without having to write this long.
Okay.
Right? Yeah. Good. So multiply the 250. So the next one is 250,000 times the factor. So 200 and okay, my calculator has frozen. It will come back to life.
So 250,000 times
227250.
227250. Okay.
Yes.
909.
22. That's 250,000 times 0.909, right?
Yes, that's
Yes.
227,250.
227250. Okay. 227,250. Okay. And this times that 250 times 0.826.
206500.
Okay. 206500. 50,000 by 0.751.
37550.
3755. Okay. 50 times 0.683.
34,150.
Pardon?
34,150.
34150.
Okay, we do the same with this one. 50 by
It's 34,
0.621.
not 84. Hello.
34.
Oh,
Yes,
yeah.
not 84.
Okay. Okay. This makes a lot of sense. Okay, 50,000 times 0.621.
31051.
31050.
050.
Okay. Okay, so we'll do the same for B. This times that is still the same. 250 times 90.909.
No, it should be 50,000 times 0.909. We are doing for B.
Okay, you have it.
It's 45450. 187750. 102450. 310500. No. It's 102450. 102450. 310500. Yes. Please, we can't hear anything. Oh.
Coach, are you there?
But we can't hear you.
Oh, sorry. I've been talking all the while. I thought you were hearing me.
No.
My microphone was mute. Sorry, I'm
Wow.
saying that. I didn't know. I was rather waiting for you to give me feedback. Now that we're doing net present value, we've got to this stage. The net present value is a summation of all of these future cash flows. Are they future cash flows or no? All these present values, discounted cash flows. So negative 500,000. This plus this plus this plus this. So sum this up, give us the answer, and do the same for project B.
So project A.
What is the name for that? The total. How do you call it? Is it
Net present value.
okay? Net present value.
Yes.
Okay.
That's what the question is requiring that we do to calculate the net present value.
Project A 1008555.
10855.
No, the zeros are 2.
Okay. Okay, 100,855. Then you do it for project B.
B is 11.
Okay,
87.
was net present value for project B at 10%.
87
8
7450. No, the 7 is only 1.
Okay, I was wondering if it's 11 million. So this is okay. So this is it.
Yeah.
That's the
And the top
difference.
first one, add one more 5.
Okay,
The 5 are
like
3.
this, right?
Yes.
So it's rather, this is rather 1008555.
Yes.
Okay,
Please, where from these figures?
you're adding this from here,
Total.
negative 500 plus this, plus this.
The total. Please, it's not that figure.
It's not too big.
It's wrong.
It's
yes.
not that figure. The A is 36,500.
500.
It's
Okay.
36,500 for A.
I'm sure the
project
person
A.
made the 500,000 positive instead of negative.
It's negative, it's negative.
Yes.
Maybe you forgot to bring the negative.
Yes.
Okay, so you said the A is
36,500.
36,500 and the B
187,450.
87,450. So which of the two is better?
It's B.
Project B. So question 1, B. Okay, so now let's go back. Let's answer this. As per MPV method, which option is better? Okay, project B, that's correct. So B is our answer. The next question is 8. What is the NPV for the project that cost this value? So this one, we don't need to go through that process. It's a multiple choice question. So let's assume that we could do it the other way around, but let's rather solve it this way. I'll use my calculator. Remember that net present value is your cash flow times discounted. So we have, what is the NPV for the project that costs this
Which question
amount?
Which question are we solving now?
Question 8.
Question 8.
Yes.
But from what about, so we have, what about the 2 and the rest going?
Yeah, we mentioned earlier on that in our previous meeting, we agreed that when we meet today, we should select the questions that we'll have to calculate and do those ones before going back to do the remaining ones.
Okay, all right.
Okay, so what is the net present value for a project that costs 104 million with annual tax cash flow of 40 million for 1 year one? So year one is 40 million. Okay, so all you need to do for net present value is to multiply, this is the cash flow, and this is the discounted factor. So cash flow for year one times the discounted factor for year one, plus cash flow for year two times the discounted factor for year two. 3 is cash flow for year 3 times the discounted factor for year 3. When you do all of that, you add them and then subtract your initial investment of 104 million. As simple as that. So let's do that together. So for the first one is 4.
$40, right?
Okay. So it's 40. Is it 40?
Yes.
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 Okay. So this is 40 times
893.
893 plus the next is 45 times 0.797 plus the third year is 50. 50 times
712.
0.893. Oh,
No,
what am I? Yeah, it's 712. That's
712.
correct. Yeah, you're right. Thank you. So these are value. You get it? 107. But this value you've got is our total.
No, I had 117.11.
Okay.
I can't see. Are you writing? I can't see the writing, or you're not writing.
I'm not writing. I'm sharing my screen. I'm using the calculator. So when we got this answer,
What is this? Your figure
actually
is wrong.
It's wrong, right?
Yes. Because
Okay.
so it might even add
The other one is 50.
Please, Fortune, subtract
The
the
second is-
104 from this, and let's see if you
Yeah.
get 3.2 million.
Yeah, that's what I was explaining. Whatever we
Eh.
have here is a summation from year 1 to year 3. But what do? We need to subtract our initial investment. So we subtract our initial investment of 104 million. And this gives us 3.2, which is A. You get it?
Yes. Yeah.
So A is our answer. Okay. The next question. Okay. Okay. So net present value, or you need to find, first of all, find the discounted cash flow. If the discounted cash flow is the cash flow given times the discount factor. What's the cash flow? And this 104 is the initial investment. Let's leave that first for now, and rather concentrate from year 1 to year 3. Year 1, what was the cash flow? 40 million. But what was the discounted cash flow? 0.893. So you multiply the 40 by 0.893, and then you add. The second year is 45 million, and the discount factor is 0.797. So what do? You multiply the 45 by 0.797. Then you do for the third year and add up everything. For the third year is 50 million times 0.712. Whatever answer you get, you now come back and subtract your initial investment. That's what makes it a net present value. Without subtracting the initial investment or other expenses, right? It is not net present value, right? So net present value means we just have to subtract something from something. Subtract the initial investment from the total discounted, the total present with value, or the total discounted cash flow. And that gave us A. So let's move on to question 9. Do the same for question 9. You don't need to draw any long table or what. Just pick the cash, forget about the initial investment. We mentioned that already. That initial investment is 28 million. But let's look at the revenues it generated. In the first year is 8 million, second 12, third 17. So 8, 12, 17. So have 8, 12, 17. But remember we said we are multiplying each of the values given by the discounted factor. So multiply the cash flow by 0.962. Multiply this by year 2. Discount factor for year 2 is 0.925. Right, and then we do for the 17. The 17 is 30, so it's 0.889. Which is here. Right, and then This is equal to, this gives us the total present value. But what do we do with this total present value? We subtract our initial investment to get a net value. Our initial investment is 28 million. So subtract, and we're getting 5.909. 5.909 is the same as 5.9, which is option D.
Yes, you are right.
Okay,
Coaching.
boss. Yes, sir.
Yeah, you stated something that I didn't get. You said net present, but when you subtract something, it becomes something. I didn't get that one clear.
I was saying that before the subtraction, everything there is the total present values, right? Then if we have to subtract it, that's what makes it a net present value, because we subtract is like your salary, where you have a basic salary, that is your gross salary. Then you can now start subtracting tax and other things. It becomes a net salary. So we can say that the answer we got before subtraction was our gross present value. And then after the subtraction, after subtracting initial investment, we got a net present value. Right.
Okay.
Yes. Okay. Now we've done 189. Let's move on to question 11. Anyway, who is as tired as I am? I can imagine how busy you are, the pressures, learning, working. It's not easy,
It's not
right?
easy. Yeah.
It's not easy. It's not easy. That is very tiring. Especially the fact that you have a lot of assignments to do and submit simultaneously.
Exactly.
Okay, so let's proceed. 11. We've done 11, or haven't we? We've not done 11, but it's the
No,
same
we are
procedure.
on
Oh no,
11.
this is payback. This is rather
Payback.
payback. So with the payback, we have to be cautious. Let's do that. Let's write this out. Okay, so for the payback period, it's okay. So let's see the year. It's always advisable to add a 0 to it. I don't know how far it's going, but let's see how many years.
3 years.
Sorry, okay, so we can stop there. So what is our cash flow? Our cash flow is, we have for the first year. For the first year, okay, what is the payback period for a project with an investment of 2 million? So initial investment is 2 million. And it generates 600,000 in year one. 400,000 in year two. And 400 and 300,000. Year one, year two,
Yeah, 3 2 is
year
400,000.
three is 400,000. But in case we have to continue, we're told that and so on. And so on, that's from year four, it's 300,000. So if we, should we add 5, it should also be
Let's add 5.
900,000.
Another 300.
If we add 6, it's also 300,000. Here, take note, please, we are asked to find payback period and not discounted payback. There's a difference between payback period and discounted payback. we're doing payback, not discounted. With, you see here, the rates were not given. And when, unlike what we saw previously, what we're told is probably we should apply 4% discount, apply 10%. We're not doing discounted factor. So there's no application of such rules. So with the payback, since we say we don't need the rate, let's just go straight and do our deductions. I invested 200,000. This is in bracket negative anyway. I invested 200,000. Okay, sorry. I invested 2 million, not 200,000. I invested 2 million. Out of the 2 million, by the end of the first year, I had 600,000 coming back to me. Right? It means out of the 2 million, I've got back 600. I'm left with how many more or how much more to recover my investment, to recoup my initial investment. So to get the balance is the 200,000 minus how much came back to me, which is 600. Why am I saying 200,000? It's 2 million. So when you subtract, this is 1.4 million. Now, by the end of the second year, I still have, by the end of the first year, I still have 1.4 million to recover from the business. But let's see what comes at the end of the second year. At the end of the second year, I had 400,000. So how much am I still left to recover? It is a 1.4 million minus the 400,000, which is equal to 1 million. All right. And question, okay, let's move on. We still have 1 million to recover, but by the end of the third year, we had 400. So it means we have, out of the million, we have 400 coming back to us. So it means that we're still left with 600 to recover. So 600,000. Now, out of this 600,000, by the end of the fourth year, we're going to have 300 coming back to us. So this is 600,000 minus the 300,000. We get what value is 300,000. Now we still have balance of 300,000. So we're going to do 300,000 minus 300,000. What answer are you getting? That's 0. So we stop here. Luckily, we don't have any other balance where we'd have to divide and do other things. So just go straight. Pick your present, your payback period to be 5 years. So going back to our question, we can see that the answer is B. Question 25 is the next one that has to do with some sort of calculation.
Mr. Fortune.
Yes, please.
Mr. Fortune.
I can hear you clearly. Can you hear me?
Question 11.
Yeah,
If you look
the question
at the
11,
question,
why is the answer 5?
I can 600,000, 400. I can hear you.
Okay. So what was the question?
So,
Mr. Fortune,
Yes, please.
my issue have to do with the 5. The
Yes.
300, the 5, the 300, yes. Where are we getting that
Okay.
one from? It's not part of the question.
Is it a part? We stopped here. Is that not? It means
Yes.
we still have 300 to recover. Is that not so? Are you saying this 300? So it means we've not finished. So how do you get, we have 300 to recover, but by the end of the 5th year, we got that 300 per, right? So that means we've recovered everything we invested by the end of the 5th year. Is that not so?
No, Fortune is asking where from where what, because when you look at the question,
Yes.
we were not giving the year that's the year 4 and the year 5.
It was
We
given.
were giving
were
up to
Let's go
giving
back
I'm
and
coming,
check.
I'm coming, I'm coming. We were
Yeah,
giving
we
up
have.
to year 3,
Okay.
but it says that the company made 300,000 afterwards, which means that even when you go to year 4, it was 300,000. Even when you go to year 5, it is still 300, or 6, it is still 300,000.
Yes.
So
So that
that's
is
how.
it.
Yes.
Okay.
So yes. So he was
Okay.
he was confused
Okay.
there. He didn't
Okay.
understand. Yes. Yeah.
Okay, that's it. So
Okay.
yes, so that's how I was
Okay.
explaining this. There's this word, it means a lot at this stage. It means a lot. So
Yeah,
afterwards, every other year,
it's clear.
every other year.
It's
Okay,
clear.
that's good. Thank you very much. So our next one is question 25.
So question 11, the answer is what?
Is a 5. I think, is that not D also?
That's the B, yeah.
B. It's B. Question 25. Consider the statements below. Project A has a negative NPV of 100,000. Right? And project B has a negative NPV of 50,000. Given this info, which of this statement is correct? Do you agree with the fact that, do you agree that project B has the smallest NPV and must be rejected? Let's say project B. Project B is negative 50. Project A is negative 100,000. Which of them is actually, so it means A is not correct. That statement is erroneous. Is that so?
That's I see.
Yes.
They must be rejected.
Yeah, they must be rejected. Why? Because all projects have negative NPV. And remember, we've mentioned before that how do you interpret an NPV? To do the interpretation for NPV, let's come here. You see, if you can only have 3 possible outcome for NPV calculations. One is that your NPV can either be greater than 0. Your NPV can be equal to 0 or less than 0. If your NPV is greater than 0, it means it's positive. If it is equal to 0, it means it's 0, neutral, right? If it's negative, if it's less than 0, it means it's negative. If you finish your calculation for NPV and you get a positive value, it indicates what? Profits.
Profit.
Here it indicates break even. But when it's less than 0, it's negative. It should warn you that there's an impending loss, right? And in this case, because they are all negative, it means that
They are all
both
lost.
of them should be rejected.
Exactly.
Yes, because they're all losses. Okay. Then
14.
yes,
A
please.
question. A
Yes,
question.
please.
I
Okay.
think that when you are working with NPV, you don't have to
Yes.
mention profit or loss. You're only looking at the viability of the project, not in terms of profit, loss, or whatever. Am I right to say?
Okay.
You don't look
Yeah,
at
you're
the
correct.
profit. When you're working with NPV, there is nothing like profit, loss, or whatever. You are looking at the viability of the project. So you don't mention it is profitable, is this, but you say it's viable or whatever. Am I right?
But if a project is negative, that means it's not viable. So positive.
Yes.
Exactly.
Yeah,
So
but
if a project is making profit, that means it's viable. So
yeah,
what Fortune is saying is also correct.
No, but in NPV, I know that you
Uh,
don't mention the word profit or whatever. You don't mention profit. Well, okay, no problem.
yeah,
That's what
I agree with you. But
okay.
with that interpretation, we're also right because one of
Okay.
the advantages of NPV is that it's an indication of profitability.
Okay. Okay. All right. No problem.
Right.
Let's move on, please. Thank
It
you.
gives you an indication that no, this business will be more profitable than the other.
Okay.
Right.
Okay. All right.
Okay.
Thank you. Thank you.
Yes. Thanks.
But
Okay.
in any
So
case,
the next one.
what I want to say, in any case, why is
Yeah.
it viable? It's viable because there's profit
We're
in it.
after profit. Yeah, there's an indication of profit.
Let's move
And
on, please. Let's move on.
okay.
So 25. Our answer is what? None of the above, right?
Hey,
No,
B must be
it's C.
rejected.
let's
C.
get it.
But
Yes,
yeah,
C.
they must be
Answer.
rejected because they are all negative.
Negative. Okay, thank you.
Not viable. Okay. So our next port of call is 40.
Fortune, please, I'm not getting that one clear.
Which one?
The question 25. My friend asked the question.
What was the question?
No, he's saying that the answer should be none of the above. And you say what? Please.
No, it's not that. The answer is C. Not none of the above. Yeah.
They are all negative.
They are all negative, so they must be rejected.
Oh, okay.
That's it. And let's go to question 40.
Yes, what the issue is.
Okay. Yeah. Someone mentioned that this particular solution has no answer, right?
Yes.
And that's
Yes.
why he thinks it was highlighted red. Who has solved it? And how did you solve it?
I have solved it and I had 4.
Yeah. Okay. How did you solve it?
So should I list it one by one?
Okay.
You let's solve yours. If there's anything I'll compare it to mine. I have to list.
Oh, don't worry. Let's discuss. We just want to discuss and see, what did you do? Did you add what did you use the depreciation?
Yes.
Yeah, I used the depreciation, but at the end of the day, I added it back.
Yes, you added back.
Okay. So that means you added the 10 to the 35.
You have
The cost is okay. So the cost is 10 million and the depreciation is at 10%, which is 1 million. When I find the 10%,
let's solve it.
Yeah, we are solving. That's what we're doing. Okay, so you can continue.
When I find the 10% of the cost, which is the initial investment,
yes,
is 1 million. So that one is done. And then they are saying that the tax is what? 2 million.
25%.
The expected annual income before depreciation and tax is so the figure before depreciation and then tax is what? 2 million. So that's the annual income. So to get, should I say, to get the net income, I have to take the tax from it, which is the 25%.
Okay. And so 25% of what?
25% of the, I can example,
2 million.
Of the 2 million.
So 25% of 2 million is a quarter of 2 million, which is 500,000.
Yes.
So when you take that out, you have 1.5 million. Okay.
Yes, I'll get 1.
Yes.
I'll get 1.5.
Okay. Correct. Yes.
I'll get 1.5. But the issue is that though we subtracted the depreciation, which is the 10% from the cost, it's not actually lost. It's an income. I don't know how to explain it. It's not lost. Like the company has not lost that money. It's an income.
Yes.
So you come and add it back. You come and add it back to the income after you've deducted the tax. to give you the real, should I say the real cash flow? Let me put it like that.
So what is the real cash flow?
So you get 2.5.
2.5, right?
Yes.
What about the income tax?
No, I've taken the income tax out. I took the income tax from the 2 million, which was 500,000.
Yes, and that is 1.5.
And then when I took it out, you get 1.5. But this is not your income for the year, because you've taken the depreciation is there, which is the 1 million.
Yes.
You need to go and add it to it.
Okay. So when you add, what do you get?
You get 2.5.
Okay.
And then you do the payback. So the initial investment over the
I think that's the part that is confusing, right? Because with the income tax, you said you do 25%. So when you subtract the 25%, it's 500,000. Is that not so? So 500,000, which is annual, is that not? So that makes this 1.5 million after the deduction of the tax. Is that not so?
Yes.
Okay, you deducted tax. Okay, so that's 1.5. Okay, so if that is 1.5, what else did you add? You added the 10% depreciation, is that not?
Yes, because how do I put it? Is an asset now. I can't explain that, please. I think it's
okay. So yes, so that 10%, that's what we all want to understand. And that 10% depreciation, right? The 10% depreciation, because remember that this 2 million is annually.
Yes.
Is that right?
Yes, it's annual.
Okay, is annually. What about the depreciation?
The depreciation is usually given at a flat rate, like it's annually. It's usually annual.
Okay, so when there is a depreciation, okay, I think I'm getting what you're saying. So if 10% of 10% of the 10 million is a million, so you added that to it. Okay, I get the angle you're coming from. But can we consider, do we actually need to consider depreciation in calculating payback?
Yes.
No. Okay, so let's quickly delve into, let's check something here.
You take it into account.
Okay,
it becomes a part of the cash flow.
Okay, so let's see what is here. What is the role of depreciation in payback period? Right. What's the role of depreciation in payback period? We're told that depreciation is an essential factor to consider while accounting and forecasting for any business. In simple words, depreciation means reducing the value of any goods or assets with time, right? It is typically measured in percentage. Okay, I have not opened that document. And this other one says depreciation is a non-cash expense and has therefore been ignored while calculating the payback period of the project according to Payback. This one sounds interesting. I'm opening this document. We just want to know whether anytime we see depreciation in payback period, whether to make use of it or ignore it. Under payback period, an investment project is accepted or rejected on the basis of payback period. Payback period means a period of time that a project requires to recover the money invested in it. It is explained by in years, okay, expressed in years. Okay. When the annual cash flow, blah, blah, the payback period of a project can be computed by simply dividing that by that. Okay, correct? I just want to see where that statement came from. Okay. I had that statement to read earlier on. There's something here. We're told that depreciation is a non-cash expense and has therefore been ignored while calculating the payback period of the project. Okay, then let's go back again and check any other information. There's also another one here. While calculating cash inflow, generally depreciation is added back as it does not result in cash outflow, right? Depreciation is added back, right? So payback period is equal to blah, blah, blah. Okay. Depreciation is not an actual cash expense that you pay, but it does not affect net income of a business and must be included in your cash flow.
But it does affect but it does affect the net income.
Okay, that's what it, but it does affect. Okay, I'll open that. If cash flow arises at the end of the year, the payback period will be 3 years. You have ever cash flow, blah, blah, blah. Okay, so let's see this one here. There was a question like that that required, it wasn't a calculation question. It was a multiple choice question that asked, is depreciation taken into account when computing payback period? And the, yes, please. Yes.
Hello, Patrick.
I can hear you.
In fact, yeah,
I can hear you. Can you hear me?
My network here is very bad. It's very heavy, so I can't hear anything from your end.
Which side are you? Which side are you?
Sorry?
Which side are you?
Hello?
Okay. We can confirm that you're not hearing us because you're saying hello, 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 hello. Okay, so let's go back to our question. Well, I'm recording.
It's raining all over Tema.
Okay, Tema. It rained I think 2 hours ago at Achimota. Meanwhile, Tema was still dry. Okay,
So we
it's
are
now
experiencing
raining
ours now.
now. Okay.
It's raining cats and dogs.
Oh, that's good.
And no doubt it's raining.
Okay. So the question is, with this particular question, should we ignore the depreciation or make use of it?
We have to use
Fortune,
One
I
thing
think we
is
have to use it.
we should use.
We have to use it because depreciation, it's like, for instance, you have an asset, and maybe that asset, that particular asset, sometimes you go to hide and you pay for it. But this time the asset belongs to you. So that's the depreciation become that money that would have gone out of you. I mean, outflow. So this time around, it becomes an inflow to you. It becomes, you earn it, so it becomes an inflow to the sponsor. So you add it to the profits.
Okay, so provision for depreciation at 10% annually. So from our discussion, the answer is not here. But what I want to mention is that whether we ignore the depreciation or add it or not, the answer is still not here. If we decide that we are going to, let's assume that we want to ignore the depreciation of 10%, income tax at 25, the answer will still not be here. Take note. Right? Yes. Yes, please.
There's a question we solved in class, so I've copied it with the solution. I've pasted it in the chat.
Okay. In the chat or the WhatsApp? In the chat. Okay.
Yes.
Okay. So here, a project of 2 million yielded annual profit of this 10%. 40% payback and solution. So profit before tax was this, less income tax, 160. We have this, add depreciation of 10%, which is this, and add this, and okay, where is this 200 coming from? So this was 2 million, right? Yielded annually a profit of 400,000, right? So annually we had 400,000 after depreciation at 10%, is that right?
Yeah.
After, take note of the after depreciation at 10%, and subject to income tax of 40%. Calculate the payback period of this project. So solution, the profit before tax was this, less income tax of 40%. So we had this. So profit after tax, it means profit after tax is 240. Add the depreciation to it. So the depreciation.
What are you sharing the chat?
Can you see it?
No.
Oh, okay. I thought you're seeing the chat. You're not seeing the chat. I'm seeing it alone.
Just click on the distance.
No, I can see it. So I thought you're probably seeing it.
We can see it.
We can't see it. Yeah.
Okay. You not see my screen.
You can see it. You can see it.
Okay. So when you click on yours, you can see it. But in the recording, you see it, I think. Okay. So 40%. Calculate the payback of this project. Okay. So 160, 240. Add the depreciation on the 200 savings of payback period is this divided by 440, which is 4.5. Okay. Yeah, so but if you click on the chart, you see what I see. If you can see this one. Okay.
Fortune.
Okay. Yes, please.
I think per the chat, per what is in the chat, what the lady was saying is correct too.
Yes.
You deduct and then add back. You see that the question in the chat, they had already taken it away from. That's why they added back. Because he said after tax.
Yes. So the expected annual income here before, right? The expected annual income before depreciation, right? And tax is this. So we added back the depreciation and
what is
took
that?
out.
What is that?
It's raining, that's why. So the person should, the sound, that's the sound of the rain. So please, your microphone should be switched off. Okay, maybe I can mute everyone.
He's not talking.
Yes, so his microphone is on and it's raining heavily. Okay, so here as per the explanation, we first of all subtracted the 25% from the 200 and we had 1.5 million, but the depreciation, annual depreciation is 10% of this, which we now add back to the 1.5 to get 2.5 million. But, and I also know that payback period for uniform cash flow, you don't need to be subtracting as we did earlier on. If the cash flow is uniform, or you need.
I can't see your screen. No.
My screen, and who else cannot see my screen?
We can see it.
Okay, that's good. So I think it's from you. Okay, so if the cash flow is uniform, all you need to do is to divide. So we are dividing 100 million, 10 million by the 2.5, which should be 4 years, and that's not here, right? Okay, so that's probably why it was highlighted red. Okay. And then you're going to meet a question that asks, I think, I don't know whether it's in this document or another one, but there's a question that's going to ask you whether you make use of depreciation or not when you're calculating payback. Okay, the gain or loss, no, we're not here. The next one is what number? This is question, so we move on to question 51. So question 51.
Hello, Fortune.
Yes, please.
Hello, Fortune.
I can hear you.
Please, the questions we are looking at, the one in the chat, is talking about depreciation after tax. But the question we are solving says depreciation before tax. So I wish you could explain.
That's why I was highlighting there. That's so maybe we can spend time and really look at that, because before and after means a lot. It could rather mean that one, the depreciation has been taken care of, so there's no need adding depreciation again, right? So we just ignore depreciation and do that. Okay. Okay. So okay. Okay. So this is before depreciation. Before depreciation, and the one we saw from the chart was after depreciation. Okay. So let's leave this one for now, and we'll find our way around it. Let's move on to question 50. Question 50.
You said 51.
Question 51. Yes, 51. Question 51. When current ratio is 1.8 is to 1, what does that mean? What does it mean to say that current ratio? So let's see what that means. How do you define current ratio? Do you remember your definition?
Current assets and
Current liability.
Current assets all over
Current liability.
Okay. What's the ratio? The ratio 1.8 is to 1 is, in terms of fraction, it means 1.8 all over 1, right? So this is 1.8 all over 1. If we want to write the statement is the same, we can just simply cross multiply. Should you cross multiply this, what do you get? It means 1 times current ratio is equal to 1.8 times current liability, right? So 1 times that, it simply means our current ratio is equal to 1.8 times of current liability, right? So let's go back and see what that means. So are we saying that, so in this case, before we come back to the question, it means that the current sorry, I've been writing current ratio instead of current asset.
Current asset rider.
Not current ratio.
Current asset.
Current asset. So it means that current asset is 1.8 times current liability, meaning current asset is far more than the current liability, which is actually positive. So we come back and check. So current liabilities are more than, no. Current assets are more than current liability, yes, but not by 0.8. Current liabilities are more than, no. Current liabilities are no more. It means that current assets are more than current liabilities by 1.8, as demonstrated here. So current asset is 1.8 times more than the current asset. So answer is D.
Okay.
Good. And the next is 55. 55. Given sale is 120,000 and gross profit is this. What is the gross profit ratio? Gross profit ratio is
Fortune.
Yes, please.
Please, what was the answer for the 51?
I think we got D, right?
D. It was D.
Please, it's not D.
It's B.
Okay, let's go back and check. Okay.
I lost connection.
Okay,
The
what is the
answer
answer?
is B.
B.
The answer is B.
Let's go back to the calculation and see.
It's not the
B.
Okay, let's see. I think we had that from what we did. We had this. We had current.
14.
So
yes.
14. Is sister trying to subtract the ratios? You don't subtract.
Yeah, you subtract. It's like I don't know how to put it. It's like 1.8 is for the current asset, and the one is for current liability. The difference is 0.8. So
Okay, you know why? Okay, do you know why here? Yes, do you know why they brought all the 0.8, 0.8?
You don't subtract ratios.
They brought the 0.8 because they know that some students will attempt to subtract.
Just to confuse the class.
This is a ratio.
We don't subtract ratios. Ratios are not.
A ratio you don't
It's not a matter of you
divide.
subtracting. It's the interpretation, and the interpretation is that the current assets, which is 1.8, has 0.8 more than the current liability, which is 1. Please, that's the interpretation.
Sister, you see, when you are having a ratio and then you are sharing money, and then they say that you are sharing the money to a ratio 2:3, it doesn't mean that you are going to subtract 2 from 3. It is something that you
Did you read the, please, Edward, did you read the options? Did you read the options, the answers, the options?
Yes, I've read
yeah,
the
options.
The last one. Are you trying to say that the current asset is more than the current liability by 1.8?
No. That's
the answer you chose.
Is that
that's not the interpretation, please. I beg you.
Oh, we are discussing.
But the proportion.
No, yes, it's true. We are discussing, but when you are given a wrong fact, when you are given a wrong something, well.
Okay, so let's reconsider it, right?
I think the lady is correct.
Let's reconsider
I think the lady is correct.
Let's have a second look and see.
It's more than by 0.8, so I think the answer is B.
Okay, let's reconsider, right? Let's understand. Okay, let's reconsider. See, we're told that current ratio is equal to
Current asset.
Current asset.
Current asset over current liability, right? Or liabilities. And we're told that the ratio is 1.8:1. 1.8:1 means 1.8 all over 1. Okay, so let's do simple maths using this first. Because we want to write this in a straightforward sentence. It means that current asset is equal to times 1. We're multiplying the current asset by 1 and multiplying the current liability by 1.8. So it's 1.8 times current okay. So let's write it in plain statement, right? English. It means that current asset is 1.8 times more than current liabilities. Do we agree, yes or no?
Yes.
Okay.
Yes,
So
that's
it means
right.
current asset is 1.8 times more than current liabilities. So let's go back to the options given. So let's compare that statement to this one. Do they match? If not, we think otherwise. Is it this statement and what we've written here? What we've written here is 100% correct.
Yes, that's
Whatever
right.
written here is 100% correct. But let's now compare the statement to this statement and see before we make any other comparison. Is it the same as saying that current assets are more than current liabilities by 1.8? What do we mean by this by? Okay.
Multiplication.
Multiplication. That is what we're told in maths. That in English, when you see by in multiplication, it means times. Right. So it means that current assets are more than current liabilities by 1.8. It also means that current asset is 1.8 times of current liability. So that's granted, that is it. But let's consider this other one and see. Current assets are more than current liabilities by 0.8.
It's wrong. It's wrong.
It's not wrong. Do you know the interpretation?
Okay.
It means for every liability of 1, the company has 1.8 to cover it. So the difference, if it's there, let's you are interpreting it like from the, I don't know how to explain it. From just looking at it.
Answer is D. It's D.
You're still not understanding, so let's move on. I mean,
okay, no, we need to. Okay, sometimes some of these questions you can find them online, maybe, right? But it's at this stage it's good we get it clear. Let's try to search for this question. Probably maybe we can get something. We can get an explanation similar.
I'm also trying to search what else.
They seem to be very confusing, but
yes, I think it's very clear. I have the feeling that it's a trap
Yes, possible because
it's a trap, but
they are
this is very
all have
straightforward.
one. So
Yes,
the asset is increased or is more than the distance by 0.8.
no, you know, this is actually basic. You get it right. This is quite basic.
Yeah.
This answer, you answer this from the
This is
point of
ratio.
ratio.
This
Ratio
I
is
don't know
simply
why.
division.
The answer is D.
The answer is I can tell for sure that the answer is D.
Yes, it's
right.
D.
I can tell for sure because it's not like probability. If it's probability, right? If it's probability, we're probably looking at the fact that the sample space is 1. Right, for probability, your highest value you can get is 1. So in that case, you need to, if the probability that something is going to happen is this, means the probability that it won't happen is 1 minus the other one. I think we can see from that angle, but for ratio there, it's this. For me, I would have taken D as my answer.
But even Fortune, in probability questions, once you are getting 1, then you are certain that that event is going to happen. Because probability is supposed to be between 0 and 1. You see, if it is not happening at all, it's 0. But if it is going to happen, then you are going to get 1. So probably is between 0 and 1. And this ratio thing,
this rather ratio.
Yeah, it's not about subtraction or
yeah.
We beg. This is accounting. We are engineers, so let's move on.
He might be right. He might be right.
Yes, please. Yes, please.
Fina, let's move on. Let's move on.
Okay. Okay, that's good. That's good. Okay, so yes, please.
Some of us, what you show us, what you are going to take. If it doesn't come, we are dead.
I just want to explain that.
Okay.
This one is not concrete and cement. We are following you people.
Okay, you're explaining something. Someone was asking a question, right?
Hello, Mr. Fortune.
Yes, please.
Please, in fact, I have not enjoyed this today's class a bit because of my network. So please kindly share the recorded version as early as possible.
Yeah, I'm recording.
Okay.
You have to come and say English, Legon.
Do you hear that? Okay, the next.
It's raining.
It's raining there. Okay, so 55. Given sales is 120,000 Ghana cedis, and gross profit is this. The gross profit ratio is what? What is the gross profit ratio? The gross profit ratio is simply the gross profit divided by the net sales, right? So you just have to divide the 30,000 by the 120,000, which is a quarter. You have 30 times 4 is what gives you 120. So that's a quarter. So you divide 30,000 by 120,000 and multiply by 100. That is 25%. So B is 25%. Okay,
30,000 divided by 120,000.
No, this is it. 30,000. 30 divided by 120,000.
Okay.
Times 100 is 25. Okay. Right. Determine current ratio. What is current ratio? If the current assets, we know the formula already. Current ratio is simply current assets. Current assets divided by the current liability. So it means 150 divided by this. So let's divide. Is it none of the above?
Yes.
So, okay. So we're simply dividing 150 by 100,000. Let me remove the zeros. That is 3 out of 2. So let's go back and check. So it means that current put in the board.
1.5?
So
1.5. Yes, 1.5.
So current ratio is current assets all over that, which is 3/2, right? 3/2 is the same as 1.5 is to 1. Take note.
So none of them.
Okay. And not 1:1.5. Take note. They are two different things. Okay, so let's see what that is. Yeah, it's when you divide 3 by 2, what do you get? No, 1.5.
3 by 2
is 1.5.
Into mixed fraction.
So
one whole number 1 over 2. That's 1.
You are speaking like an engineer.
That's correct.
Yes.
So that is
1 over 2. Yeah. That's 1.5.
So that is the same as 1.5/1.
Yes.
Right? Okay, because let's use a calculator. See,
the answer is 7.
If I do 1.5 divided by 1, what do I get? 3/2.
Get the same thing.
So is 1.5/1 is the same as 1.5:1 in terms of ratio.
Okay.
So you see the confusing part here. When you go there, they've actually put this here. Instead of putting 1.1:1, they rather made 1:1.5. So a number of people may be tempted to select B, which is not so.
Just to confuse the class.
Right? So the answer is D. Yeah, the answer is D. 57.
That's true.
So the correct answer should have been 1.5 is to 1.
1, yes.
And they put 1 to 1.5 just to confuse you.
Okay.
And the pressure, a lot of people select B, even if they know that you might not have a second look. You just want to shade and move on. As long as you've seen 1 there, there's 1.5, you just shade.
Okay.
No, 14.
Let's move on to 58.
Coach, is this the question you want to solve at this?
You put some profit back into the business. Is that not so? Hello.
Hello.
Can you hear me?
Yeah.
Yes, we can hear
we
you.
want to see interest cover. So I was mentioning that with interest cover, anytime you make profit and you share profit with your partners, right? You all take the profit home. How will the business survive? You need to put back some of the profit. You need to put some of the profit back into the business, right?
Yes, that's
the
right.
profit you put back into the business is called operating profit, right? So the question is, with respect to interest cover, you ask yourself, this profit I'm putting back to the into the business, is it sufficient to pay back my interests, the interest I've taken on loans, right? So how do you do that? You just divide the profits by the interest you're supposed to pay. That's it. So in this case, interest cover is operating profits.
Which number is that, please?
Interest cover.
58.
58.
Okay, sorry.
So interest cover is operating profit divided by interest payable, right? That's the interest you're supposed to pay. So what is the operating profit? We go back to this and check the operating profit. What is operating? Is given here. This is operating profit.
120,000.
120,000. So we divide the 120,000. But what interest are we supposed to pay? We'll see interest payable. Interest paid or payable is 20,000. So 20,000, 120 divided by 20 is 6. So 6 times.
This lecturer, is he seeing us as accounting student or what?
It's not
pure accounting of
Hey, you come and teach us this. And look at the pure accounting question you are putting here. That's like you are asking the accountant to calculate the number of blocks for 1 bedroom.
So they should take these ones out and give it to the accounting students, right?
I mean, this is no.
And
you can't teach us 1 month and you're expecting us to know accounting like this.
Accounting is deeper, so this one is even shallow. They want you to know the shallow.
Yes, but it's
still deep. It's still
Anthony,
deep.
they want you to burden your mind.
Yes.
Mr. Oscar.
Yes, sir.
If I give you some parameters,
Fortune, please, let's continue. Some of us are feeling please.
You can't calculate, even though it's the basic.
Because of time, let's go on. Okay, let's go on.
Okay.
Let's make
so
progress.
59. We're supposed to calculate Tyco's return on capital employed. What's the return on capital employed? ROCE. We wrote the formula the other day, but it's here. Return on capital employed is the operating profit, which is 120, divided by the share capital plus reserves plus non-liability times 100. So operating, sorry, what did I, hey, the rain has started here.
Return
the rain has started in my place here.
It's already raining here, so as far as here.
Wow. Operating profits divided by share capital. That's the ROC. That's what we're calculating. So it's the I was praying that it doesn't rain today.
Oh, it was announced on Instagram and social media. So
and I've not been out. The only thing I check now is just WhatsApp, because there are a lot of WhatsApp messages you read and respond to a lot. So I don't even have time to check Instagram and all of that, even Facebook. So this operating profit divided by share capital.
Reserves and non-liability. So on the table, where is the share capital?
We'll find that. Okay. Share capital plus reserves. Who is that? Hey, speak with the person. Tell me. I'm in a meeting. I've almost ended the meeting. So speak with the plus
Reserves
plus non-current liabilities. Non-current liabilities. So non-current liabilities times 100%, right?
Yeah.
Your name is?
Okay. Operating profit is 120,000.
Yeah.
What is the share capital? Let's check there. We have a share capital.
Okay. He said he's doing the recorder. He said he's doing it.
Okay. So were you given share capital? Accounts receivable, account payable, long-term loans, cash, investment, equity share. So it's 100,000, right? Yes.
Yes.
What is it? Yes. So all of 100. Okay.
Plus
100,000 plus what's the reserves? Reserves. Do you have reserves? Do you have reserves? Account payable, loan, cash.
We have inventory.
Oh,
Inventory
are
is
not reserves.
Yeah.
Oh, inventory is not reserves.
Non-current assets, no net profit, equity share. We don't have it, so that is zero, right?
Zero.
Is that right?
The non-current liabilities.
What is the non-current liabilities? So we have non-current. This is asset. It's not a liability, right? So account receivable. Long-term loans can be considered as non-current liabilities, right?
Non-current.
So let's take this one to be a non-current liability. What other one? Inventory? No. Non-current asset? No. So I think we can. This is
It's a long-term loan, right?
Yeah. The internet falling in front of you.
The rain has come to affect the internet.
This area. I said it. Now, on Obi or teacher, yeah, friend, so rum break. I brand TV.
Why if I friend why?
Eh, yeah, friends on rum bra. Oh, check. Banka beda yo ya. Hey,
Maya, Omoya, the status of Muhaji.
And where they are.
What I won't bow Mukrumunda. Oh, yes, I'm what it is. Oh,
Hey, Master, we couldn't hear you.
When in I will.
Mike.
Yeah, Charlie.
You did there.
Welcome back.
You know the network did me small.
You go enjoy small coming. Don't worry.
Oh, the network fuck up.
And the lecture, you want you to stop the quantities and become an accountant by phone.
are you there? You can see the screen, but I can't hear you.
If you say writing, no.
He has produced
the voice.
Oh, sorry. My mic went mute.
Hey, are you sure?
Yes.
Go over, please.
Oh, I just used a calculator. I've done this. I just used calculator to calculate.
Tell us the secret too.
Okay, I hear you.
Review cost.
The site. Okay, can you hear me? It's raining heavily. The wind is just so much.
Yeah.
Okay, I divided 120,000.
Okay. In the rain.
No, the noise.
I thought you were in the rain teaching.
There's so much.
That's interesting.
The wind. Yeah, it comes with the heavy wind.
Okay, so this is all we have. We multiply this by 100.
Okay.
And that is, I multiply by 1,000 rather, it's by 100.
100, so that would be 17.
Yes.
19.
17%. 0.1, but I think it's been rounding off, so just 17%.
Hey.
This is where we had it.
It's 100. 100.
But we were looking for, I think the
non-current liability is the same as the reserve.
Yes.
So the reserve. We are looking for the reserve.
No, there's no reserve. The reserve is zero.
Zero.
The long-term loans are also the same as non-current liability.
Yeah.
It's a section as well.
Okay. And the last but not least is determine the gearing ratio. Gearing ratio.
Gearing ratio.
Yes, the gearing ratio is here.
It's long-term liabilities over share capital plus reserves plus long-term liabilities.
Okay, that's a long one. Yeah, this is it. Long-term non-current liability divided by shares. Okay, what is our share capital? what's our reserve, and long-term is the same thing. The only difference is that this is long-term. The numerator is long-term liabilities. The long-term liabilities
and that is the 600.
The 600. So it's the same thing, but this rather becomes 600.
Yeah.
Instead of 120, is rather 600.
700.
So divided by the same 700,000.
So 600 divided by 700. Okay.
It should be 90.
$86, right?
Yeah.
86%. $85.7. So that's
right.
D.
Yeah.
That is D, 85.7. That's correct. Okay, that's the end of this. We can't solve this today. It's already 10. It's 10:20 thereabout.
Yeah.
Okay, we've done well today. So we're ending the class. I'll share the video.
All right.
Good night.
Good night.
This one that you're in a hurry like that.
I'm going to fetch water. I'm going to fetch water. I'm going to fetch water.
Hey,
the wife is calling you. It's good. The wife is calling you.
I thought you
The weather is good. All the time.
The weather bring himself. Enjoy yourself. Oh, good night.
Okay, good night. Thank you, everybody.
Good night.
Okay. Bye.